All right, excellent. Well, on behalf of the Center for Leadership Ethics and the Eller College of Management, we'd like to welcome you to the wonderful, delightful, fantastic property here at Hacienda del Sol to our 2025 Executive Ethics Symposium. Once again, we have a full house. Big round of applause to all of you for making this entirely possible. So my name is Paul Melendez, and I serve as a University Distinguished Outreach Professor in the college. I'm also the very proud founder of our Center for Leadership Ethics. And for those of you who may not know this, the center has really achieved some kind of international recognition. We not only do some extraordinary research on organizational ethics, but we teach undergrads, MBAs, and including PhD students. We also are very well known for some really innovative outreach programs that target K through 12, collegiate, and executive levels. Today's program, our Executive Ethics Symposium, is just one example of these wonderful programs that we do for our community. I'd like to begin by thanking our generous sponsors, our title sponsor, Zane's Law. So if I could have Doug and Claudia please stand. Thank you, Doug and Claudia. I'd also like to thank Vantage West Credit Union. Where are our friends from Vantage West? Round of applause. And we'd also like to thank Dr. Humberto Lopez, who received an honorary doctorate from our college, and the Humberto Lopez Foundation for their support. So a big round of applause for This symposium has a long history and connects right back to Doug and Claudia, who have been longtime friends of the center. In fact, Doug serves as the chairman of our advisory board for the CLE. I'd like to acknowledge a few of my colleagues that made today possible, and quite frankly, to receive an award for bearing with me. I have a very bad tendency of allowing the invitation for very good reason to help us explore today's topic. So, kicking things off a little bit later in the program, we have Cody Ritchie from Crest Insurance Group. We have Dr. Seth Wackler with Arizona State University. A lot of the work that he's going to be talking about today. And then, of course, we've got Tom Zupan with the Arizona Department of Insurance and Financial Institutions. We have all the makings for another outstanding symposium. So with that, I'd like to welcome to the podium the chair of our Center for Leadership Ethics, Mr. Doug Zanes. Doug, come on up.
Such a great deal about the Center for Leadership Ethics, about Paul, about what the center is trying to do. And it really stems from, I think, as Paul said, I've been active with the center for probably the last 12 years. And, when we first met and he first began to talk to me about the center and really what its purpose was, it really fit with the way that Claudia and I have tried to build the law firm and how we've tried to make decisions, whether it's, everything from what do we want our brand to be, to who the right clients for the firm are, or who the right team to surround ourselves is. But it's all about sort of the thought process. Because I think Center for Leadership Ethics is kind of it's a little bit of a misnomer. I mean, we all know we're not supposed to cheat on our taxes. We all know we're not supposed to do bad things. Really what I think the center is about is it's about teaching, in particular young people through the different case competitions, or you guys through the Symposium, about thoughtful decisions. And actually thinking about how the decisions you're making, whether it's in business, personally, impact the world around you. Because with every decision that's made, I mean, there are consequences to that decision, there are reactions to that decision. It's kind of a ripple effect. And that's really what I think the center is trying to teach young people through the collegiate case competition and high school students through the high school case competition. Because really what they're doing is taking a problem, taking an issue. It's a complex issue that is good for some people, maybe horrible for others, and trying to think through the decision and explain why they've come to the conclusion that they've come to. And so when I think about it from a real world perspective, I mean, years ago, we were probably, or I think we were, the first law firm in the U.S. with a non-attorney secret. And the reason for that, quite frankly, is because most state bars said it was unethical to have a non-attorney secret, and to have non-attorney business management people within the firm, because for some strange reason, the concern was, these non-lawyers would tell lawyers how to work cases. Even though you have legitimate business people run hospitals, run dental practices, accounting firms, and 1,000 other professional services, for some reason, that wasn't what the rule. So we made a decision. And the decision was the person in our company who really understood business would run the business. And I would run the legal end of the firm and deal with the lawyers, deal with the cases. We probably didn't think through all the ripple effects of that. And one of the ripple effects of that was a number of years later, an attorney whose name I won't mention filed a bar complaint because we had a non-attorney CEO. And so we dealt with that. The ripple effect that attorney would realize was a big motivating factor to change that. And so now Arizona is the only state in the country that can have non-lawyer law firm ownership, non-lawyer law firm management, which I think a lot of lawyers really despise. Now, will that be a good thing or a bad thing? I don't know. It was something that I thought needed to be, that we thought needed to be. And time will tell if that's a good thing or a bad thing, it all shakes out. Because we're only 3 or 4 weeks into that change. But the point of all of that is decisions are very complex and very complicated. And decisions affect lots of people down the street. And the center's purpose is to help young people, help people understand that, and help people take a step back and think before they make decisions. And weigh the costs, weigh the benefits, weigh the consequences. And make the best decision that they can make the decision that they think is the right decision, which is much different than just making a decision. something that certainly I deal with on a daily basis with what we do, from a business standpoint, something, quite frankly, we've dealt with on a personal standpoint, which is insuring our house. It affects everyone. The decisions that companies make, well, the decisions that companies make are made by people within those companies. And so it'll be interesting to kind of hear everybody's take on it. But that's what this is about. It's simply about making decisions based off of the whole, thinking about the whole before making decisions. And if we get everybody in this room, everybody in the Senate, to do that, we think it is hugely impactful for the society. That's what the Senate's about. So thank you for joining us. Thank you for being part of this. And I hope you have a good morning.
Okay, again, a big thank you to both Doug and Claudia for their generous support and allowing us to continue this wonderful program. What I'd like to do is give you a little bit of history concerning the symposium. I'd like to give you kind of a high-level overview of today's topic, the format that we're going to follow, and then I get to kind of retreat back and allow my colleague, Professor Ricky, to go ahead and do his work as the moderator today. So we started the Executive Ethics Symposium back in 2010, and we have covered just an array of topics. As I think back to those early years, we talked about socially responsible investing before it really became a thing. We also talked about, at that time, this new nascent technology called artificial intelligence. And today we think about all of the iterations. Back then we also talked about this new movement called the benefit corporation movement. We've also talked about cryptocurrency. Last year we talked about environmental, social, and governance, ESG. And, today we're going to be talking about, as the title suggests, extreme weather, insurance practices, and the volatility of home insurance. As Doug said, I think this is one of these topics that touches every potential stakeholder. As I was preparing for this year's symposium, it was just fascinating. Also impacted by changes in the industry. We think a little bit about some of the extreme weather. Today is not about arguing the merits of it, right? What we're experiencing right now is some of the most extreme droughts, floods, fires, tornadoes, hurricanes, and it's not just impacting, as we know, California, Texas, and Florida. In fact, right now, and our panel will probably address this, there's about 20 states where we're seeing insurance companies doing a multitude of different, making a multitude of different decisions, including increasing premiums, canceling policies, not insuring certain segments of some states and communities, and even picking up states wholesale. And the other interesting thing about this is that it's not just in these large areas. I was interested to learn a little bit about Louisiana and how that is becoming very difficult to insure, even a state like South Carolina. Right? So we're seeing a lot of these extreme events playing out in places in the U.S. that we haven't traditionally seen. So today is an opportunity with our panel to really explore this. Right? I'm of the opinion that the weather is the weather. Right? The insurance companies are there to make a profit. Right? Homeowners are being impacted. Right? But I believe that there's also got to be some accountability from everyone. Right? Not just the businesses, not just the government agencies that regulate this, but also the homeowners. Right? So the accountability, I believe, in the end, if we're going to really try to solve some of these pressing problems, is going to kind of involve the collective, which is largely why we're bringing everyone here today. Today is all about giving you, as some of our guests, these, what I like to call kind of fresh insights on the topic, some of the best practices that organizations and companies are taking, and kind of the ethical path forward, right, as we kind of go through today's program. So what we're going to do today is we're going to have each of our panels present for 15 to 20 minutes. We're going to have Cody, we're going to have Seth, and then we're going to have Tom in that respective order. After they do their presentations, we're going to take a break. And the break is more to give you an opportunity to begin to jot down some questions that you might have for our panel. And then when we return from the break, we're going to then turn into our Q&A portion of the symposium. where the panelists can take questions that will be given to Professor Fricky and really try to explore this topic a little bit deeper. With the balance of time today, our hope is that you're going to enjoy yourselves, you're going to continue to network. We've got some extraordinary people here, and also maybe if you'd like, take advantage of the opportunity of having our panelists here for a little bit this afternoon or this morning. So with that, I'd like to go ahead and introduce today's moderator, my colleague, Professor Michael Fricky, who's also our Associate Director for the Center for Leadership Ethics.
All right, welcome everyone. I love this event every year. We have a lot of fun. And as Paul was saying, over the years we've done a lot of really amazing topics for this event, and a lot of super cutting edge stuff, crypto and benefit corporations, like brand new stuff. And I know one of the classes I teach is an entrepreneurship law class. Like Doug, my background is in the law. And we spent some time in my entrepreneurship law class talking about insurance and how important it is. And when I first say the word insurance, my students are like, well, what else can I do for the next 10 minutes while we talk about this, right? And because they're like, it's not necessarily the first most exciting thing that people think about, especially 20-year-olds in my class. But as we talk about it and how this is a way for you to protect yourself, your company. These are budding entrepreneurs, and how important it is both to the macro economy and to you personally. They start to the light bulbs go on. They're like, oh, this topic that I thought was super boring, something all my parents cared about, is actually something really important. And before today, the panelists and Paul and I and Diana all had a Zoom to just kind of do some planning, and we got to kind of talking about what you're going to be hearing about from the panelists. And we just got to talking, and they started going back and forth, and I was like, man, this is great, because this is the part of insurance that is so relevant and interesting and exciting, and I know Paul had the same reaction, and so I'm excited to hear what they have to say. That's just a long way of saying I'm excited to hear what they have to say. So I do have a request of you. On your table, let's see if I can show these. There's a stack of cards. They look like these. They have the Zane's logo on the back and QR code, and they say questions for the panelists. As we go through the panelist presentations, as we go through the panelist presentations, please write down questions. At the break, leave them on your table, or at the break, if you want to take some time to jot down questions then. We're going to collect them during the break, and then part of what I'm going to do after the break is kind of curate the questions for our panelists during the Q&A session. So, yeah, as questions come up, please write them down and just leave them on the table. We'll collect those during the break. So, as Paul mentioned, each of our panelists will have some remarks for roughly 20-ish minutes. So, without further ado, our first panelist, I'm going to turn it over to Mr. Cody Rich.
Good morning, everybody, and thank you very much, Michael and Paul and Diane, for inviting me to be one of the speakers today. And as usual, I have a question for some of you students. How many of you guys prepare for a test a month out? Hands up. How many of you prepare for a test the night before? Okay, that's me. So I was asked by these fine people 6 months ago to prepare for this, and I'm really tired because last night at about 11 o'clock I started working on it. But that's part of the course. Mike, you said something about insurance in college. I'm a graduate of the University of Wyoming. I got my master's here at the University of Arizona. I took insurance in college, and I got a C. I took the same professor that summer, Dr. Edward Escolas, and I got an A in his real estate class because I thought it was way more interesting. But as fate has it, I don't think any of us in the insurance business thought we were going to get in the insurance business unless our family was in there. So I'm the founding managing partner of a firm here based in Tucson called Crest Insurance Group. And Crest Insurance Group is I'm really proud of ourselves and my team. We started in 2010. We bought ourselves back from a bank that owned us. At that time, everybody was being gobbled up by bigger national firms, and we thought that Tucson needed a hometown type firm, like Doug's law firm. And what we did was, we started out with 20 people, and we're now at 330 people. We're in 18 locations, Southern California and San Diego, all over Arizona. We're right out, we have a really nice office in Tempe, Cutting Edge. My oldest daughter graduated from the Sun Devils. We have a lot of the Sun Devils that work for us, and we have a lot of lumberjacks. But we have offices all throughout Arizona, including Flagstaff, Cottonwood, Sedona, Lake Havasu, Sierra Vista, Tucson, Phoenix. And that's important because we can talk about kind of like the wildfires and things that are happening. California, we know what's happening in California because of San Diego. We have an office in Las Vegas that does trucking only, with 2 little offices in Texas, one in Fort Worth, one in Houston, and then we have offices up in Colorado and Wyoming. I asked a few of my colleagues to come here today, and I wanted to introduce it at break or afterwards if you want to ask them any questions. They're more knowledgeable than me. I look over and at this table over here is Yvonne Baldwin, who's the one person at Crest Insurance who's been there longer than me, and she does personal lines, and she used to be very, very happy she could get deals done in like half an hour, Yvonne, and now it takes maybe 3 or 4 days. Right next to her is Carly Nuri, and Carly is a young lady, graduate of the University of Iowa. She has a designation called the CPCU, which is, in our company, there's 2 people that have a CPCU. So she's a real student of it. She graduated, she got a degree in insurance in college. Next to them is Joe Hickel. I'm really proud of Joe. Joe's a Tucson guy. He was president of the Conquistadors a couple years ago for the golf tournament, a real community person. And he was our broker of the month last month, beating all our guys in Denver and San Diego and Phoenix. So I always cheer for Tucson. Always cheer for Tucson. And then the guy, if you wave right there, this guy, we owe him a debt of gratitude. He was a 22-year Navy SEAL, graduate of U of A with an MBA from Eller. And he came back to us a couple of years ago, and he's our risk manager. So he knows a lot about risk if you want to talk to him about it later. Over here at the table, my wife Patsy, who's really the boss of the firm. Doug, you know what I'm talking about. Andrew, who works with us, who's a young broker, and Winston, 2 young brokers. Over at the table with the Zanes is Richie Martinez. Richie works in our Tempe office. He is the Zanes insurance broker, and he is my insurance agent. And he's really, really, really good. And we'll get into it a little bit later, but talking about the perils and the market, 2 years ago, without any claims, I had to switch my insurance. The insurance company I had, we live up here in the foothills, they canceled my insurance and everybody else's insurance because of wildfire risk. And then finally, over here, Heather Perrin, who's our Chief Operating Officer. She started in personal lines with us 15 and a half years ago when we started Crest, and she's now the boss of the whole entire company. So she does a great job. And just recently joining us, and this is cool for you Wildcat fans, is Matt Bielbach. Matt's our general counsel. He was a esteemed basketball player for Lute Olson at the University of Arizona. He was our attorney when we started Crest. And here's a cool statistic. How many of you guys like U of A basketball? Like big time? Who really likes it? Like who's somebody I could ask a question to? I know you, Joe, but how many professionals that you think have come out of the University of Arizona since Lute Olson? Is that like 55? 55, 50 something. Do you know how many Arizona Wildcats, Sean Elliott, Mike Bibby, Steve Kerr, Richard Jefferson, Channing Frye, Benedict Matherin, you know how many of them, did any of those guys ever lose a home game? Any of those guys I mentioned? They all did. There's only one Wildcat history who never lost a home game, and that's Matt Bielbach. So anyways, I just want to talk a little bit about Crest. So Crest, we do business nationwide. We do commercial insurance, which is probably about 70% of our revenue. We do personal insurance, which is very important to us, which is about 20% of our revenue. And we also do health insurance, which is about 10% of our revenue. Thank you, Zane's Law Firm, for being great customers, both on the personal and commercial side. We are at a crossroads. if we can, there's a slide, if we can go forward a couple of them. Look at that, no, back one, please. That slide right there, talking about extreme weather. I am not here to say if I believe or don't believe in climate change. We are brokers. We don't take the risk. We broker the risk. Okay, so we place the coverage. If you were to own a business, your personal insurance, we place the insurance. So, but this is, the numbers don't lie, right? The data doesn't lie. And I always say, I am like an artist. I am a salesperson. I am the person that is going to try to explain and say, oh, it's not that bad. We can work it. If I go outside, the sky is blue. If an actuary and underwriter goes outside, they're going to say the sky is gray. It's about the storm. That's their job. So we have to find equilibrium between the data, the science, and the art of the sales, but the numbers eventually don't lie. So these are our top 10, and that's only since 2017. That's a little shy of $300 billion of claims. And look where they are: California, Louisiana, Texas, Florida, Puerto Rico, Central U.S., California, Hawaii, Western U.S. And that's only in the United States. Think about things in Japan, all over the world. So most of you remember the wildfire in Maui a few years ago. Last year, we had the California wildfires in the Palisades. I think that $45 billion number is way low. Insurance is regulated state by state. It is not a national, and we can talk about that with Tom later. It is not set nationally, so every state does things differently. California, in my opinion, does something that I don't think really bodes really well for the consumers. Many, many years ago, they made their insurance commissioner position a elected position. So in a lot of states, it's appointed by the governor, the existing governor at the time, isn't it, Tom? Like here in Arizona. So in California, it's an elected position. So naturally, that person wants to get reelected over and over and over again. If I was the insurance commissioner, that's probably what I would do. But their objective maybe isn't realistic. So what happened in California was several years ago, led by you guys know what the difference between captive insurance companies are and non-captive? Not captive insurance, but a captive insurance company would be a company like Allstate or State Farm or Farmers that has their own agents that represent them. We are independent brokers that handle like 30 or 40 different companies. Maybe in some cases, what, we have 300 companies. So the captive insurers, led by State Farm, would go to the California Insurance Commissioner and say, we would like a rate increase of 35%, and then 35%. So if you're paying, $1,000, and then now you got to pay $1,350, it's going to hit your pocketbook. Wouldn't you agree? So everybody was like up in arms, and they kept denying it. So in their opinion, they couldn't get the rate they needed because they started doing what they call predictive modeling. They started getting better at looking out into the future based on the past, but looking into the future and saying, this is what's going to happen. We're going to have this hit us. And so I could just imagine Bloomington, Illinois, a couple of years ago, when some analyst went into the CEO of State Farm and said, we have to pull out of California. California, the largest state in the country, I think they wrote, I don't know, 10, 20, $30 billion worth of premium. So they're saying we're going to walk away. They grandfathered some accounts in there, but they were going to walk away from writing any new business. You think that person looks like a genius today at State Farm? That person looks like an absolute genius because they would have been just decimated. So State Farm pulls out of California because the insurance commissioner wouldn't allow them to get their rate. Then Farmers pulls out. Then Allstate pulls out. Can you imagine the pressure on the system? We have clients, I'm going to point at Yvonne here, 4 years ago when it first happened. Do you remember the account we had? She was in tears because it was a client we had for many, 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 many years, and we were always able to get them insurance, get them coverage. The people had homes worth, they had 3 homes I think worth like $15 to $20 million. they were quite wealthy. And so everybody's saying no, 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 no. And what they did in California, they formed what they call the California Fair Plan. And what the California Fair Plan would say is, okay, we'll insure that house with higher deductibles, and we'll insure it for like $3 million. So the people were really basically bare in between what their house was valued at and what they were insuring it for. So then in our world, they have something called the excess and surplus line insurers. You guys have all heard of Lloyd's of London? There's a lot of different companies like Lloyd's of London that are out there, led by Warren Buffett, probably the smartest man ever to do business in the United States. And he would come in with his company and he'd say, okay, we'll take that risk. And they're not regulated by people like the insurance commissioner. Why? Because the standard carriers, the captive carriers, and then the people that we represent all pay into what they call a guarantee fund. And so if they go insolvent, there are some monies left for claims. The surplus line carriers can make the rules. They could say, you know what, if you had $20 million of losses for a business or a home, we could still fund you coverage. It's whether you could afford it or not, okay? So there's always those carriers that will do it. So the surplus line carriers came in and they said, we'll take that risk. And so for a home that may have been $4,000 might be $35 or $40 or $50,000. So that maybe the uber wealthy could still afford it, but it started putting pressure on the middle class, and especially the lower income people. Here in Arizona, a year and a half ago, so we talk about all of these claims, but we can all remember the Mount Lemmon fires, a decade ago, the fires up in Pine Top, the fires up in Flagstaff. It is hard for us now to find coverage for people like in Tucson that might have a house in Tucson and a house in Pine Top. We're able to do it because of our size, but if you're a person that, the example I'll give is I got a call last April 1st from a friend of ours, and they were like, hey, can you guys help us with our homeowners association in the White Mountains? 72 homes. It had been insured by a company called, really good company, called American Family Insurance Company. The American Family agent was like 76 years old. He'd written this homeowners association for 20 years, and he met with the board and he goes, I think it's going to go up. I think it's going to go from, I think they were paying like $28,000, and he said, I think it's going to probably go to 45. And there was a revolt. They actually removed the HOA president. So my friend became the HOA president and said, can you Crest help us? I'm like, when does it renew? Tomorrow night. Like, I go, no, but let's see what we could do. So I called around, it was like 10 o'clock, 10:30 at night. I called one of our guys up in our Denver office who specializes in mountain HOAs, and he said, well, we could maybe do this, 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 and this. So we recommended that they renew it. Guess what the premium was? When the guy had a quote from the excess and surplus line world, and this is not a lie, not exaggerating, and this was this year, guess what the premium was? Okay. What's that? 75. 75? More guess? Anybody else? Ted, you guess. 150? $465,000. 72 homes, so they did an assessment, and I think everybody had to pay like $9,000 or $10,000. So we got to work on it, and fortunately for us, somebody else delivered them the bad news. 6 months later, they moved midterm, which is really kind of a no-no because there's all sorts of different rules and regulations. But if the savings are good enough, we wrote it for $290,000. And the total insured value was like $26 million. Our company said, we'll insure it for $20 million. The previous company, I forgot to mention, that did it for $65, only insured it for $10 million. So then they're like, well, what if we all just don't go through the HOA and we just insure it ourselves? Well, you have the same issue, the same problem. So it's hitting us. If we go back to maybe the first slide. So the key obstacles in personal insurance are catastrophic weather and climate. We just talked about that. Wildfires, hurricanes, catastrophic storms are pushing insurers to reduce capacity, which means that, so for example, we, Crest, we're domiciled here in Tucson. We have clients, we do commercial accounts in Florida. Our Florida client might call us up and say, hey, can you insure our home in Boca Raton or the Keys or something like that? The insurance department there is going to protect domiciled Florida insurance brokers. And they'll say, we can only give X amount of capacity. You might be able to write 1 or 2 out-of-state accounts a year. We have to protect our local guys. So an insurance company may have said we could write $1 billion of capacity in Florida. We're only going to write $100 million of coverage in Florida. Reinsurance costs, all insurance companies, including State Farm, including Farmers, including any company you've ever heard of, buys reinsurance. Again, you know who probably the biggest reinsurer in the world is, or second biggest reinsurer in the world is? Warren Buffett, out of Omaha, Nebraska. He never loses, you guys. That guy never loses. Global reinsurers continue to raise prices, shrinking options for homeowners and personal umbrella coverage. I found out myself, like I told you, Doug had the same issue. Auto insurance, we're not going to get in there. Litigation, social inflation, nuclear verdicts are making personal umbrella coverage harder to place with lower limits and tighter underwriting. So just in talking to Doug before, he was telling me like some states like Florida, California, Texas are allowing like these verdicts of $100 million, $150 million, things like that, which really will never be collected because there's not the money there. I think in Arizona you said $5 million was maybe the
verdict years,
5, 6, $7 million. By the way, they're a phenomenal law firm. We're going to get into tort reform later, but there are some very good attorneys out there. And if I had a claim on my house, I'd call Doug. Regulatory constraints, and that's where Tom will come in a little bit later. Rate caps in some states limit insurer flexibility, leading to withdrawal from entire markets like we talked about in California. Positives on the horizon. Auto rates are kind of leveling off because of telematics and that type of stuff. Innovative in risk management, as Paul talked about, AI, telematics, smart home devices, and enabling more accurate pricing and rewarding good risk. So my agent over here, Richie, calls me up and says, you guys have to put in an automatic
water flow system, an automatic water flow.
Yeah, shut-off system. Because we had a claim several years ago, about 8, 9 years ago, where the valve just leaked out and we weren't home. So now, if you put that in and you get that and you're a homeowner and your insurance company requests you to do it, it's smart. Consumer awareness. Clients are increasingly open to higher deductibles and risk prevention, investment, and making placement more feasible. So like what I do, because I know the game. I know the game really well, right? Do you know what the most expensive layer of insurance is? Pardon me? No, the layer. It's the first dollar, right? Because that's where most of the claims happen. Too many people are programmed to think of insurance as a warranty. So you're a young person. You might pay. Do you know what you pay for your car insurance? Yes. So let's say you pay $2,000, okay, a year, and the younger people have to pay the most on the car insurance. But for your homeowners or whatever, the higher deductible you take, if you turn in claims like it's a warranty, if you think that insurance companies want to write to about a 40% loss ratio to be profitable after they pay all their adjusters and claims and things like that. So if you pay $2,000, they don't want to pay more than $800 if they can. They model for catastrophes. They model. If you have one huge claim, they're okay with it. But if you turn in tons and tons and tons of claims, speaking of business ethics, Paul, how much longer, like 5 minutes, 10 minutes maybe? When we started Crest in 2010, we were all just grinding it out. And Heather here and Yvonne made an insurance company. We had the drafting authority to pay claims for glass claims, for anybody that had a glass claim on their car. So the insurance company trusted us. They gave us a check account, checkbook, and we would write checks. We had a lady, and it was the saddest thing ever, that had been with us for 30 years, that started writing her checks, herself checks. She formed a fictitious company to the tune of almost $100,000. And she'd go to Wells Fargo, and it was called Tucson Glass, and she would write out. And Heather, when she first joined us, started calling our clients, and she said, Mr. Smith, I advise you that we shouldn't shop your insurance this year because you've had several glass claims. And he goes, what are you talking about? I was like on a 2-month cruise. And she goes, well, no, you've had claims. He goes, I didn't file a claim. So we did the investigation, and the insurance department came down. We reported her, and we had to pay the $100,000 out to all our clients. And that was within our first 15 days of starting our company. So I always do the right thing. But anyways, if we can go to the next one. Next one, please. Between 2013 and 2023, home insurance rose 35% in premium, as contrasted by general inflation of 19%. Between 2015 and 2025, the premium increased 60%. And then it's largely driven by rising home repair costs, inflation in building materials and labor, and an increase in frequency and severity of natural disasters. And COVID really was just it was really tough. One more, please. There's some things that are helping. That with the homeowners and personal insurance, market dynamics, rising cat losses, like we talked about, from wildfires, floods, hurricanes, carriers retreating from high-risk states. By the way, a lot of insurance carriers love to do business in Tucson. We don't have hurricanes. We don't have wildfires except for the foothills. We don't have tornadoes. We just have really hot weather in the summertime. The current challenges: volatility, restricted availability, heavy reliance on state-backed FAIR plans. Like I predict that the California FAIR plan will go bankrupt. I don't know, maybe you can talk about later, Tom, or Seth. Ethical considerations: affordability versus solvency. Many people are underinsured. Access to coverage in disaster-prone regions. So I talked to my partner in Phoenix last night. He writes an account. It's based out of Dallas, Texas. It has $300 million in property values. And so they have a 1% hail deductible. So 1%, that's still $3 million. So for any hail claim or wind claim, they have a $3 million deductible. So I'm like, what do you do? He goes, dude, what do you think I do all day, every day for the last 7 years? He goes to the Lloyd's market and buys deductible bond, buy elements, which costs a fortune. And then emerging solutions, there's incentives for resilient construction. So in states like Florida, they're building higher quality construction, public-private risk pools, paramedic insurance. That's something that's new. So that would be like if there's a Category 5 storm and then somebody would insure for that. You don't have to name the storm, but if the winds were 150 miles an hour and above, they pay like 100% of the claim. If it's 125 and above, they pay like 90%, 180, all the way down to like, if it's 80, 0. So it's triggered, they pay the claim quickly as opposed to traditional insurance. So that's something that's emerging. And then the last one, if there's one more, that's parametric. We could talk about that later, but if you guys can, it's triggered by a measurable event. The payout's pre-agreed amount, no adjusters needed, why it matters, fast payouts, clarity for the policyholders, useful for catastrophes. So we tried to do it for the White Mountain Country Club that we insured, and they decided against it. Examples: the windstorm I talked about, flooding, and an earthquake. And then one more. I think I have one more slide, and then I'll let these smarter guys talk. Tort reform. So I called Doug. I'm like, geez, Doug's my friend. He's the sponsor of this thing. I just want him to know that I do appreciate attorneys. Matt is an attorney, right? Matt's an attorney. My old boss, Bob Mueller, who's great, he's like, if you think about it, he goes, without attorneys, they don't need us, the insurance. So they're really our friends. Good attorneys are our friends. And so I too am a consumer because I don't take the coverage. So if I have a claim or need somebody, you need to go to somebody who's very reputable, like Doug. In Florida, where they were having issues with, it's a peninsula, they have huge catastrophes, they have lots of hurricanes. There was one attorney that I filed like 15,000 lawsuits, and he wasn't even showing up on behalf of his clients and customers. And I think what we talked about is in Arizona, it's a 2-year process to file, Doug. In Florida, it was 4 years, so they reduced it to 2 to be like other states. So it's helped out somewhat. They're still gonna get there. They're still gonna get there. So that's all I want to talk about on tort reform. Is it state by state? I'll be part of the panel. We can talk further. Thank you very much for your time, and I'll hand it over to our next speaker, Tom. Or no, Seth.
Technical adjustments here. I really appreciate the viewpoint from the insurance industry, what it's like out there, people involved, on a day-to-day basis, writing these policies, given our current environment. And so we're going to transition from the insurance industry viewpoint to an academic viewpoint. So I'm going to turn it over, Seth, I'm going to ask you to use that mic right there, to Professor Racklin. Do you want me to use this or use this?
I can use that,
All right,
thank
very
you.
good.
All right. Okay, is this on? All right, now I think we're on. Terrific. Okay, so first of all, thanks very much. I'm delighted to be here today. This is my first time ever in Tucson, so I have no posse with me. This is kind of going in and out. So I have no posse with me. I'm actually a New Yorker. I've only lived in Arizona a few years, which will make the next part of the story make sense to you. So I was teaching yesterday my global politics class. Let me actually get the tort reform out of the window there. I was teaching my global politics class and mentioned to the students that I was coming down here to do, let me try this one. Yes. Mentioned to the students that I was coming down here to do this. And at the end of class, the first row of students, they stood up and they made some crazy gesture with their hands and they told me to bear down. And I had zero idea what they were talking about. So they explained it to me, so I think I'm probably qualified to speak to this audience. So I mentioned global politics, and it's very kind that you think of me as an academic, but I did indeed spend most of my career in the insurance industry. I spent it as a consultant. So I have worked with almost every insurance company on the planet, except for Allstate. I always point that out. Somehow they eluded my reach. And through the course of my career, I built a lot of the predictive models that Cody was telling you about. And so I teach global politics now. And the connection is that what we're talking about here, we talked a lot about what was going on in Arizona and the West and the like. What we're talking about today is a global problem. Okay, it's a global problem in two respects. Number one, the cost of extreme weather is going up, is being felt everywhere on the globe. And number two, the capital that's required to pay the claims is global capital. Okay, because we're not accustomed to thinking of the insurance business as a capital markets business, but it absolutely is a capital markets business. Okay, so Cody mentioned the reinsurers. So yes, Warren Buffett is indeed a very big reinsurer, but most of the reinsurance money comes from Germany and Switzerland. So Swiss Re and Munich Re, two huge reinsurers, and as they allocate that capital, they're thinking about what the weather is like all over the world, what the storm environment is like all over the world, and they're hedging their bets and they're placing their bets, and they are the ones who are setting the cost of reinsurance, which ultimately informs the rates that we all pay to insure our homes and insure our businesses and those types of things. So that's one aspect of the global side of it. The other aspect of the global side of it, and I was talking to a young man over here at this table who doesn't work for Cody, and he was telling me that he's a finance undergrad here, and he's going into the capital markets. Well, there's a emerging and very, very growing business called catastrophe bonds. And what are catastrophe bonds? Catastrophe bonds are the way that all of us can bet on the weather. So we buy a bond and it pays out. It pays out to the insurance company if there's a disaster, and if there's no disaster, we get a premium return on our funds. So we're talking about a global problem. We're talking about a problem that needs ultimately a global solution. But we are, as we will learn later, we're going to attack it state by state, country by country, and the like. So when I say it's a global problem, what do I really mean? What I mean is that when we look at losses from natural disasters, and I'll apologize, I've got lots of numbers in my presentation because I am indeed an academic sort. And as Cody said, this is not about whether you believe climate change is true or not. But what you have to believe is true is that the economic losses from natural disasters over the past 10 years are significantly higher than the economic losses for the previous years. Now, disaster being what it is, it's a bit noisy, right? So 2005, which is not labeled there, that's the year of Katrina. That's obviously a very high number. But if you look at the overall trend, folks, is not particularly good. So these are, by the way, economic losses. This is the total cost of what happens when an extreme event happens. And I point out here that when we think about these losses, we have to think about what's causing them. So here in Arizona, I live in the mountains in Cave Creek, and I have had a fire that was 2 miles from my house only 5 years ago. We think about wildfire, but what's driving a lot of the global disaster world is windstorms, convective storms, flooding, those types of things. So tropical cyclones, I cross my fingers. I'm still like an insurance industry guy, so I cross my fingers as we enter every hurricane season, hoping it's going to be a mild one. Lately, I haven't been doing too good with those hopes, but here we are. It's only beginning of September. We can still dream. We can still hope. We had at least one hurricane this past week that didn't do as much damage as they thought. So let's be hopeful as we indeed enter this season. So that's the kind of landscape. I think, look at this, doesn't matter where you stand on climate change, things like the fact that we as a human race continue to move to and build in places that are very, very susceptible to storm. Okay, a lot of net migration to Arizona, a lot of net migration to Texas, a lot of net migration to Florida. Europeans, by the way, Europeans do the same thing, so don't think it's like me picking on folks in America. We have concentrated our riches as a people in places that are extremely vulnerable and extremely dangerous. And now we have to do something about it, right? We have to do something about it. And part of the reason we have to do something about it is this thing called the protection gap. So I love the insurance industry. I spent a career in the insurance industry. It's been very, very good to me. And I'll be the first person to tell you that when disaster strikes, insurance companies pay, but they only pay for a piece of it. And they only pay for a piece of it because the economic losses that are associated with the disaster always exceed the insurable costs. Okay, so if a huge storm happens and it destroys the road that leads to my store, okay, my store may not suffer any physical damage, but my store may be out of business and have economic losses because nobody can get there. So economic losses are always going to exceed insured losses, and that's a protection gap. And as the overall size of losses gets bigger, the size of that gap gets bigger, and as the size of that gap gets bigger, it becomes a problem for us as an economy, it becomes a problem for us as a world. The scariest statistic that I'm going to put in front of you today, the one that makes me very, very sad, is this one. This one is from Munich Re. and that is that only 88% of homeowners have homeowners insurance. It's double what it was 10 years ago. And I didn't put it up there, so many of you may be thinking, well, insurance is expensive, so rich people decide to self-insure, and that's why that number is the way it is. That's not the case. Most of the people who don't have insurance have incomes under $50,000. Okay, so we've got two problems here. We've got a lot of the losses that could be incurred not getting covered by insurance, and we have people exiting the insurance market because they can't afford it. And why can't they afford it? They can't afford it, and Cody brought some statistics to bear. They can't afford it because it's getting more expensive. And it's getting more expensive at a national level, and it's getting more expensive here in Arizona. So from 2021 to 2024, according to the Consumer Federation of America, Arizona saw a 48% change in home insurance rates. And I can speak from personal experience. I experienced 100% change in home insurance rates in that same period of time. So why are people leaving the market and deciding to go without insurance? They're deciding to go without insurance because it's too expensive and they can't afford it. And as evidence of that, I'll look at that two ways. Number one, home insurance expenditures are growing faster than inflation. So yes, inflation matters. And yes, in particular, the cost of sheetrock and the cost of home materials and all those kinds of things matter significantly. But so too does the cost of these extreme weather events and the fact that it's just getting a little more dangerous out there. So you see, two different ways of looking at it. Number one, median household income going up more slowly than insurance. But I think, the piece that second statistic that I hope you walk away with. So we got that 12%. I want you to go with the fact that the percentage of our budget, because this is what it comes down to for consumers, right? The percentage of their budget that goes to insurance doubling over a 20-year period. So now homeowners insurance, 2% of their overall budget. Now 2% doesn't sound like a lot, but it actually is, it is quite a bit. And I do some work with the III. III recently did a study, and what they found was increasingly for homeowners, the escrow component of their mortgage payment going for homeowners insurance exceeds what they're actually paying down on the loan. So digest that for a second. Digest that for a second. It means when you go buy a house, and we have a huge, huge housing crisis in the United States. When you go buy a house, you better not just be thinking of what your interest and your principal is going to be. And we won't even talk about interest rates. But you have to talk about what your homeowner's insurance is going to be. And maybe one of the reasons that the average age, I have two children, and I view it as a personal responsibility to get them set up in homes because I know they could never do it on their own. When we think about why the average age of homeowners continues to go up and up and up, insurance has something, not everything obviously, but something to do with it. So I talked about the people who are going bare, as they say, going without insurance entirely. There's another large group of people that, as Cody mentioned, are going to these state-operated plans. And you can see here some statistics. What is interesting to me, what is significant to me, in part as a political scientist, but also as part as a insurance industry person, is this is a private market increasingly becoming public. So we're all in a business school here, and we're all believers, I believe, in the ability of markets to handle consumer needs, the ability of markets to handle our economic needs. And what you have here, and I say this with a level of boldness, is evidence of the beginnings of market failure. So when people leave a private market and have to be in a public market, that's evidence that the market is failing, at least for some of those people. And the market isn't failing because of how it's pricing the risk. It's actually pricing the risk very accurately. The market is failing because the risk is higher than the private market can bear. Okay, I would love to offer private medical insurance for 80-year-old people, but there is absolutely no way to price that anyway where I could make money. And that's why if an 80-year-old wants medical insurance, where do they get it from? They get it from the government. So this is early days. These are not massive numbers. It is 20% of all houses in California that are in risky areas. But this is the beginning of a market transformation. Now, health insurance market, we all know how it works. When we're young and healthy, we're old and get sick and no one could insure us, we rely on the government. That's where we're headed. That's where we're headed unless there's change. And so I thought I would kind of conclude by talking about sort of where things are going. And Florida, of course, provides a very good example because Florida, as you all know, if you even a casual storm watcher, not a aggressive storm watcher like me, but a casual storm watcher, you know that Florida often bears the brunt of Atlantic hurricanes, which are still the single biggest cause of insured loss that we know of. And so what Florida effectively did as a state was it entered the reinsurance market. It said, in effect, we are going to be the reinsurer of last resort. So we will provide a level of catastrophe coverage, the intent of which is to reduce the cost of private reinsurance. So we're going to kind of take the top off. This is not, by the way, dissimilar conceptually from what the US government did after 9/11. Because after 9/11, insurance companies said, well, hey, there's really no way we can insure very large structures against terrorism risk because no one has enough money to pay for the 2 tallest buildings in the world collapsing. And so the government set up this kind of stop loss type program, which is called TRIA. It's a very successful government program. It's been profitable every year. It's been enforced, and it stabilized the commercial property market. So Florida successfully did this in the homeowners market by creating this reinsurance program. They also, to name check Cody again, they also have done a lot in terms of tort reform to really address kind of the tendency of juries to award people lots and lots of money for things. But the key point here is that who pays for the cat flood? Everybody in Florida. Okay, and that means if you live in, I can just make stuff up. If you live in Ocala, okay, you're paying for the millionaire with the house in Naples. Okay, so look at the map. Ocala is in the middle of Florida. So this creates, and I have to bring it back to ethics because that's why I'm here. I'm here to talk about ethics. So the first ethical question when there is a problem is who's responsible for causing it. Okay? And probably agree that the problem is being caused by, depending on your religious views, some kind of celestial force. So we probably can't do much ethically with punishing that person or that being. But then the second question you have when you have a problem is who is responsible for addressing it? Who is responsible for fixing it? Do we expect insurance companies to willfully lose money Well, that seems to not necessarily be fair to their sources of capital, to their policy, to their investors. And in fact, you know, I was with the CEO of State Farm, and I said to him, you know, like, what are you doing in California? And he said, it's not responsible to our policyholders, because State Farm is a mutual company. That means the policyholders are, in fact, owners of State Farm, and they rely on its financial stability. It's not responsible to my policyholders in 49 states to be placing this big bet on, to bet their surplus, to bet their company on California. So he had a very ethical argument for doing what Cody told you he did. You can accept it, you can reject it, that's your call. But the point of the matter is that ultimately we have to decide who's responsible and who pays to fix the problem. Because the capital markets, combined with some kind of taxing authority and assessing authority, you can make the money work. It's still not a good situation because it costs more and more money. You can make the money work, but figuring out who pays and what makes it fair is a big problem. And so I put up here, and I don't want anybody who's worried about this stuff to get terribly afraid. I put up here this federal catastrophe reinsurance bill. This is to do effectively at the federal level what Florida is doing at the state level, and therefore give it more stability, and we won't be worried like Cody is about the California plan going under because the federal government has seemingly infinite resources. This bill will not pass. Okay, so I put it up here as an indicator that the discussion is happening. And the discussion is happening, obviously, because there's a problem. I convinced you of that. And the reason this bill won't pass is because of this question of who should really be responsible for paying. So should the people in Iowa, now Iowa, those of you who know Iowa know that it does get some pretty nasty tornadoes at times. But should the people in Iowa be accountable for the Malibu cliff falling into the ocean? Like, don't live there. You've seen it happen. You've seen the movie. You know what happens. People are rushing back to go build in the Palisades. Should we as a people be underwriting that? It's a good question, right? Because ultimately, this question of responsibility is not just about what insurance companies should do or what reinsurers should do. It's about what all of us should do. How can all of our behavior be better calibrated to the risk that's out there? What can we do to actually reduce the cost of risk? And that's sort of the ethical challenge. Okay, the whole principle of insurance back in the early days when it first got started was a very simple promise among people who knew each other, ship owners, in Greek ship owners and English ship owners. And it's a very simple promise. If something happens to your ship, I got you. Something happens to my ship, you better got me, right? You better have me. That's what it is. That's what the word mutual means. That's what mutual insurance is all about. But is that promise valid if people behave irresponsibly? Do I have you if you run your ship aground because you don't bother to check the tides? And that's kind of the world that we're living in now. I'm going to stop there.
Thank you, Seth. Oh, there's Tom. I assume there was some sort of government insurance-related emergency.
I trashed the regulators while you were
No, I wasn't running away.
All right. Oh no, your chair is falling. Yet?
There we go.
Okay. Yeah, there's a health insurance claim right there. All right. Thank you, Seth. I'm going to turn it over to Tom to give us a government perspective.
Well, this has been very interesting for me. I think everybody is totally accurate on what they're saying. Mine is not going to be as elaborate or in-depth as what they went into, but I think touching on what Seth said at the end, there is a moral obligation in terms of when you file a claim. So It's not a warranty. It is something that is for catastrophic losses. It's not something that you should always apply because your rates will go up and you will be non-renewed at some point. So just consider that. So let's see here. So I've been with the department about 10 years now. I have a risk management background with the state of Arizona. So I moved over to the Department of Insurance to start supervising the property and casualty rate and rule form filing. Excuse me, I'm a little nervous here. So now I'm doing data analytics. So just like with all the insurance companies, big data is becoming very, very important to understand what the markets are doing, what claims are doing, everything in general. So there are a lot of data calls going on to try to understand what the homeowners market is doing nationwide as well as in Arizona. And so that's what I'm primarily focused on. So one of the things that was alluded to is insurance in America is state regulated. There's not really much of a federal oversight per se, except for TRIA has some involvement. But all the regulators in the US are part of the NAIC. It's the National Association of Insurance Commissioners. And so they meet to discuss issues that affect all of us on a statewide or national basis. Let me get my breath here. Yeah. So they've been doing this since 1871. And what they do is they create model laws that all the states try to emulate in some basis or form. So whether it be how you review rates, what type of policy content is in their exclusions, coverages, things like that. So they'll try to set that, and then the states will adopt those. Most of the laws that Arizona has adopted are from 1955, okay? Some have changed over the years, but not very dramatically. And they also do insurance research. So they have a huge area that has data collection. They do training for all the regulators, so regulators are aware of what is going on nationally and can adapt to it. So this map here shows you, as was alluded to, that some states are elected and some states are appointed. So you can see there's 11 states here that are elected, California being the one that seems to be dominating the conversation. Arizona is appointed by the governor, confirmed by the state senate. So one of the things about insurance rates in Arizona is they are use and file. And so what that means is some states are pre-approval of rates. So when an insurer wants to change their rate, their rating practices, even their underwriting, they're required to file with the regulating state. So in some states it's pre-approval, some states it's file and use, where they basically have to file and then they can start using. In Arizona, they can start using the rate change 30 days before they file. Most insurers will file sometime in advance. And just to that, so since we're use and file, the only thing that we can do is to look at the rates and make sure they're not excessive, inadequate, or discriminatory in the nature for what they're being used for. And if we do, we usually try to have a dialogue with the insurance company to make sure that the filing is documented to show those aspects of the filing, okay? One of the things that comes up a lot is on your auto insurance policy, it's governed by the ADOT motor vehicle laws. Title 28 says you have to have bodily injury and property damage coverage, and it specifies what that coverage should be. For homeowners, we follow the New York standard fire policy. And so it is a basic policy that if your house burns down, it's covered. But of course, they can have exclusions for everything else, earthquake, flood, and anything else they desire. So we only can govern your homeowner's policy to cover fire. One of the other things is In the rate making, they're using a lot more predictive models. These predictive models are generalized linear modeling. I don't know if anybody's familiar with that. But there are a lot more robust modeling techniques where they can incorporate hundreds of variables, characteristics of an insured, to identify where they should be placed. So instead of you being a pool where everybody pays the same amount of premium, the differential between what you pay and what your neighbor may pay could be significantly different based on any number of characteristics that come into play. And again, those characteristics can't be discriminatory, and they have to be understandable by the department to say, okay, that characteristic has some correlation to a potential loss. So if you file frequent claims, that's a correlation. You're going to keep filing potential claims, and so your rate should be higher. It also has a more refined, and then the only savings grace is there are actuarial standards that govern this. So is anybody studying actuarial science? Nobody? It's
You
a good
should, they
career.
make a lot of money.
Yeah. So they have standards of practice that make sure that they, as the individuals that are developing these rates, look at it from an ethical standpoint. And so when I started with the department, that's where it gave me a little bit of calming that at least there's some standards that are held to it, and there's a whole board that will oversee those actuaries to ensure that they are doing it accordingly, okay? So the models that predict your rates going forward are different than the models I think that were referenced before on CAT models. So CAT models are more the catastrophic events. And typically in rate making, when you have a catastrophic event, it does not typically always influence the rates because it's usually a very infrequent but high severity. So they usually take it out of the rate making consideration. And so, but CAT model are primarily used by the reinsurers because what they're looking at is they're using that upper layer of coverage for the insurer. They're going to be covering all those billions of losses based on huge amounts of homes being destroyed by a hurricane, earthquake, flood, or severe consecutive storm, or a wildfire. So here's an example of a CAT model, but it's by NOAA. And what it is demonstrating is over the history of time, this is where the most severe convective storms are occurring, severe weather, whether you have winter events or not hurricanes, but tornadoes and such. There would be another one for a hurricane that NOAA would produce. So the one for wildfire risk, if you look at it, here's where NOAA has identified, based on what has occurred in the historical past, this is where wildfires occur. And so you mentioned Tucson and in that area, Mount Lemmon. Just naturally, you think about the vegetation. And if you look, southern Arizona is right in this. So if you go down to Patagonia, Sonoita, there's a lot of vegetation down there that potentially could burn, okay? The other map on the other side, though, this is what the insurers are looking at, is if you look at that, where is the exposure? Where is the exposure associated with the wildfire risk? And so when an insurer looks at this and says, okay, in these areas such as around Flagstaff, there's a high exposure, there's a high potential for wildfire. And then they look at the insurer that they're reinsuring and they basically say, okay, we think you're overexposed. Because if there was a wildfire in that area, potentially all the homes in that area are going to burn. Okay, and when they burn to the ground. There's usually not halfway. So I think that's really indicative of why in California, a lot of the reinsurers looked at it and said, you know, most of these companies are overexposed, and they actually promulgated folks moving out of the market, or at least thinning out the market. And of course, since there's not sufficient insurers writing, then you're going to have a fair plan. One of the things about Arizona, we don't have a fair plan. We don't need it most of the time, but we have been in the last couple of years hearing from producer agents on the unavailability to obtain insurance. Some of the things we found is, there's over 200 insurers writing in Arizona. But for an independent agent, they may only have an agreement to write for a certain number of those. And so what we try to do is provide a list. Here's the insurer saying they're writing in those areas, and hopefully an insurance agent could then go, and I know it would be arduous, but go through and call all of those. It's not to say it's a guarantee, but it's letting everybody know that there's potentially insurance out there. It's whether or not you can obtain it. And I'm not saying it's going to be affordable, but at least you have a contact with an insurance company that potentially could provide it, okay? So we only have an assigned risk plan, which is the same as a fair plan, but for auto. And in Arizona, so there are so many auto insurers, and there's such a free market in terms of the rates, that there's only like one commercial account in that auto plan. And that's pretty significant. And that was established by statute some years ago. So again, there's no statutory provision for a fair plan, which is fair access to insurance requirements, because your mortgage usually requires you have homeowners insurance. And the statutes require that you have auto insurance, at least for bodily injury or property damage. And then the other one that's mandatory is workers' compensation. So businesses have to have workers' compensation. And so there's a fair plan or an assigned risk plan for that coverage. But for homeowners, there is not. So going back to that risk, so what I've highlighted here is Flagstaff and Prescott. And this is a map of Prescott. It's a blown up map of that CoreLogic or Cotality's risk map, where they feel that there's a significant exposure. And this is what is going to drive whether or not an insurer is going to write in that area. So the objective here is to try to get as many insurers to diversify the risk to cover that area versus just having one like State Farm writing everybody, because they're just not going to do it. They just won't do it up there. And the other thing that, if you've ever gone up to Flagstaff, most people, there's pine trees in between the homes, but usually between each of the homes is a wooden fence. And what insurers are now considering is that wooden fence is like a fuse between each of the homes. And that's what happened in California, in Palisades, that happened in the Paradise, and that also happened in Hawaii, is that now you have conflagration. Those homes might have been built such that they had a low fire risk, but just because of the connectivity between the homes, now they all burn together. And so I think that's what a lot of insurers are starting to realize, is it's just not this individual risk, it's more the community risk. It's looking at overall, what's the exposure of the entire community. And I think, Arizona's had, with the Mount Lemmon fire 10 years ago, that was a good example of what happened with underinsured. Most of the folks up there did not have adequate coverage to rebuild. And the same thing is going on in California. There's a lot of underinsurance that they're just not going to be able to afford to rebuild. And I think some of the statistics I've heard is there's less than a dozen building permits having been issued for some of that area. So that's a significant concern too. So I can speak to rates. When I was doing a lot of rate review, it's more of a holistic viewpoint that you would see the rates come in and you'd slowly see that there's a trend here. Everybody's starting to increase their rates. And I think it was alluded to, the auto rates have stabilized. We're starting to see some stabilization. COVID had a dramatic effect because they drove up the severity. But on the homeowner side, the rates are going up because of inflationary factors. Building materials, the ability to find a contractor to rebuild. And so instead of you being moved out of your home for 6 months, you're going to have to stay out 18 months. So not only are you going to cap out on the relocation aspect of your coverage, you're going to have to be out of pocket on that. Okay. So my message is pretty simple. I mean, these have been pretty in-depth. I agree with everything they were saying. What the department is looking at is how to convey the message about prevention and mitigation, the NEIC as well as the insurance industry have a lot of programs for prevention and mitigation. So everybody's aware of like the crash test dummies, the IBHS, that's Insurance, Bureau, or what is it, of Highway Safety. So they crash test vehicles, they test them and they know the safe vehicles, and that drives the industry to make safer vehicles. They also have the IBHS, which is the Insurance Institute of Business and Home Safety. And so what they are doing now is they're burning homes. And I think you've seen a lot of this at their facility, not in the population. And so what they do is they do exactly that to identify a home that would be safe, in terms of being fortified against potential wildfire risk. What are the things that cause ignition sources? What can be done to prevent it? And so there's a lot of programs in the other states that are related to home hardening. And a lot of this with the IBIH was in the East Florida, Carolinas, was because of hurricanes. And so they needed to identify the majority of the roof damage was roofs being blown off. So they identified how to make and build a better roof. So now they've moved over to how to build a better home to be more resilient to fire. And so that really brings into the consumer, is how do you get the consumer involved in the preparedness and the prevention and mitigation of their home. And that's an expense. But there are some simple things. Getting rid of a wood fence that joins your property to your adjacent owner. There are vents typically on your eaves that you should have designed to prevent embers from entering. And then to get rid of all the nice vegetation that you built up to the home, because that is what's going to help cause or ignite your home. All right. But other than that, that's what I have.
Thank you, Tom. All right, another round of applause for our amazing panelists. So as I mentioned, we are going to take about 15 minutes, refresh your coffee, use the restroom, whatever, but make sure you write your questions on those cards. Just leave them on your table. Our staff will come around and collect those. And we'll come back in about 15 minutes, and we'll do the Q&A section portion of our day. So take about 15. who wants to field each question? If more than one of you want to, we're casual here, so do whatever you want. But I'm going to kick it off with this one, which I think is very interesting. Do you foresee there being a push in encouraging people to start thinking about living in less risky areas, especially given the rise of like remote work over the last 5 years?
Want to take it first?
Sure. Theoretically, that makes a lot of sense, right? I mean, it's a big country, and there's places that are more or less exposed to risk, and we tend to like the riskiest. It's a hard thing to do practically. So there are financial incentives. It is cheaper to buy a home way cheaper to buy a home in the Midwest than it is to buy a home in Arizona or California. Your insurance is indeed less, and so insurance is providing an incentive in a way, right? Because, I mean, it's a way to live a more affordable life. The book I just finished writing is about the whole work from home phenomenon. So, yes, I think that remote work and telework and those types of things afford people an opportunity to live in different kinds of places. I read an article just recently about Detroit, which is not a city that I've been to recently, and apparently Detroit has been attracting a lot of young remote workers who want to live in a city that is, yeah, this one is, it goes in and out. Yeah. They want to live in a city that is affordable. So I think there are increasingly financial incentives to move away from the most disaster-prone areas. But we do like our beaches, we do like our shorelines, we like our mountains, we like our deserts, we like the fact that it's 80 degrees in December, and so that is, of course, a counter pressure. So I think it goes both ways, and I think that there are indeed incentives, but I don't see people pushing people to move out of the coastal areas in any kind of a policy type of a way.
I think that's a good question, but look at the count. In Florida, there's no state income tax. So if you're paying more for homeowners insurance, you're not paying state income tax. So there's always something there that's, so I think insurance, it's important. People have been leaving California for years. Our former governor, Governor Ducey, when I would go hear him speak, he used to always turn and say thank you to the state of California for helping send people to live in Arizona. And it's a lot less expensive to live here. But I don't know if insurance is specifically the thing. And with remote work, I just want to say something about that a little bit, because Heather and I are smiling. We lost a few employees, during COVID, that we built this, I think, this really unbelievable business here in Tucson with great benefits, lifting people up. That's what you really want to do as an entrepreneur and a business owner. You want to help people. You want to give them a career. You want to help them change their lives. And so all of a sudden we would hire people, and we might have somebody that used to work for a direct writer insurance company making $13 an hour. Next thing you know, they're making $60,000 an hour. And then they would come leverage us for a $100,000 job working remotely for an agency out of New York or Miami or Beverly Hills. And it was a really, really tough time for us because we did lose a few really good people. But we did get some really, really excellent people too, because the economy is always changing and turning. And Geico used to have a huge call center here, and they let 200 people go. So all 200 of those people were looking for a job, and we got their 4 best ones. So the remote work thing, somebody with gray hair and loves life and loves people, and the culture, that's my own little thing that I want, my own little commercial. We do have some remote workers. Usually they're people our age that have been around for a long time. The younger workers, there are those great jobs out there, but I would encourage you to get into an environment where you can work with your coworkers, because I learned from the people like me that were older than me, sitting right next to them and going and talking to them all day long. So that's my 2 cents about remote work.
the only thing I would say, I think everybody has a choice of where they want to live and everything. I think it is going to be driven by whether the cost is affordable, because I think what we've seen is that folks that live in the WUI area or in forested areas, insurers didn't really recognize the risk as much as they are now. And so now they're charging accordingly for that risk. If you're building in those wildlife urban interfaces or into a forested area, you're going to pay a premium on that through insurance. And so I think that is just the economics of things, is whether or not you're going to be able to afford it based on those things, insurance. And then, you know, some of the things that a lot of states are looking at is just building code. There's going to be an increase in building codes that to prevent that type of activity, not in Arizona, but other states are contemplating that to ensure that those homes that are built there are built to a code that is will mitigate the risk also.
All right, terrific.
Yeah. That's all right. I'm used to talking in front of large groups of students, so I can be loud. So this question gets more at the sort of ethical dimensions of what we've been talking about. Am I reading this? So insurance companies canceling coverage is sometimes compared to this idea of legal redlining, because it sometimes disproportionately harms vulnerable communities. What are your reactions to a claim that when companies pull out of an area, it actually is worse for underprivileged communities, and that sort of thing?
No. Well, we don't call it cancellation, we call it non-renewal. So a cancellation, there's statutes specifically about cancellation, and you have to clear that threshold. Non-renewal is a different aspect. There used to be, for auto, used to be standards for what would trigger a non-renewal. It was decided that those standards for non-renewal were not necessary, and so it's more liberal for an insurer to decide to non-renewal. On the homeowner side, there are specific conditions for non-renewal. One of them is condition of the property. If they deem that the condition of the property, whether it be a higher risk, they have to inform the insured, who has the ability to correct that and mitigate it, and then it can't be non-renewed. In regards to, is it impacting disproportionate economic folks? Yeah, because some of these corrective measures that need to be taken are costly and they can't afford it, versus somebody who lives in an area that they can afford to put a metal roof on their home. They can do everything to mitigate it. So that is a concern about the affordability, and I think some of the studies that are being done is to what can be done to help mitigate that, and a lot of states are offering grant programs to assist in those mitigations. The fortified homes in Alabama and South Carolina, that's a big example of what's going on to help people get their homes to where insurance is affordable and obtainable.
Yeah, it's funny, we were talking to a marketing student during the break, and I began my career in the marketing world, and then I got into insurance, because as Cody said, nobody gets into insurance on purpose. So I ended up in insurance, and the thing I learned, the thing that struck me the most with all of my marketing training was I'd never seen a business where we choose customers, we don't just attract customers. And the thing to understand about the insurance business is that it's a process of selection. Okay, insurance companies pick the customers they want. Insurance companies don't sit, they go, how much better can we be at allocating capital to risk that has a return associated? So it's a very different kind of mental map than many of us who've been in business or run businesses typically adopt. And so I'll make another plug as my answer, as opposed to the long-winded introduction. My answer is, and I think picking up on the last comment, this is why it is a public-private problem. Okay, because risk itself is something that we all experience and that we all face. The ability of us to transfer that risk at an affordable price is increasingly challenged, and as a consequence, public-private solutions to, in essence, fix that market failure are really the only way forward.
All right, thank you all. Next question. Several of you mentioned that some states have appointed insurance commissioners, some states have elected insurance commissioners, some states they're appointed by a commission. What are your thoughts as to whether an elected insurance commissioner or an appointed commissioner is more susceptible to the changing winds of politics?
That's all you.
Well, I'll just say, our department looks at the statutes. The statutes drive how we implement insurance in Arizona. So we do not establish policy as it pertains to that. That is up to the legislature or to the governor. So in an appointed position, in elected it might be different, but from our perspective, you know, the way the statutes are written dictate what an insurer can and cannot do in this state, okay? And that, I'll just leave it at that.
I would just pose the question back to the person who asked the question. Look at Arizona, look at California, and what state you think is governed better. And so I would say Arizona is, and there's more. So the elected position, I don't care if you're Republican, Democrat, or Independent. A lot of times elected officials are going to say what they need to say to keep getting elected. That's their paycheck. Where it's an appointed position, in my opinion, because we do business in all 50 states, the states that you showed up there that have appointed positions, they're still accountable to the governor. So when the new governor comes in, they can fire, but oftentimes they're career people, and you get continuity. So you don't get just some person maybe who's an elected insurance commissioner who knows nothing about insurance. So that's my 2 cents.
I don't have any sense on this.
Okay, this actually relates a little bit to one of the earlier questions that I asked, but how far in advance do these predictive models label an area as being high risk? And are homeowners notified in advance that the risk level of their property is changing? I mean, this is not my question, but just, I mean, as a personal example, like I live in a flood zone, and when we bought our land, our real estate agent was like, well, you should just ask them to see if you can like get it rezoned as not a flood zone. And I said, I didn't even know that. Is that a thing you can do? Like, and so like, how do they go about changing the designations for risk for these properties that people own?
Well, it depends on the type of risk you're looking at. I think, you know, most of the predictive models for the cat risk, you know, predominantly were like the hurricane models and the earthquake models. But as severe convective storms, those hailstorms, tornadoes on the inland, winter storms, and now wildfire, those are new predictive models that are coming into play more and more. Most of the trending on hurricane, you know, it's a huge historic trend, and the frequency of storms is continually increasing, and that is being systematically inputted into those models. So they have a pretty good handle on it. Wildfire is a totally different beast because the dynamics change. An area could burn today, and for 2, 3, 4, 5 years, it's not going to have that same risk factor as it did, you know, 5 years previously. So those types of models have to constantly take into account those dynamic changes. Flooding is related to wildfire because once you have a wildfire, you're going to have a flood. And some of the flood maps that were done, those were FEMA. Most insurers would not touch flood because the only flood maps that were out there were those developed by FEMA, and they were they weren't detailed enough. And so we have seen an increase in the number of private insurers wanting to write flood as an endorsement to a homeowner's policy because they've gotten better models that really help identify within those high-risk flood areas homes that really aren't high risk. And that goes to your point about, you know, sometimes the map is saying everything in this area is high risk when in fact somebody's sitting on top of a 500-foot mound and they're not going to get flooded. And those are the ones that get written.
Yeah, so the insurance as an industry is and I don't say this in a negative way, it's a backward-looking business. So it's a classic example of past performance is a predictor of future result. So how do we know what's going to happen? We look at what happened, and then that tells us what's going to happen. And the challenge with that, of course, is that the world is changing faster than our experience of the world. And so, there is a virtual arms race, and I use the term obviously metaphorically, but there's a virtual arms race in the world of weather modeling, predictive modeling, CAT modeling, and all of that. So every time there's a new storm, there's a new version of the models because the models didn't get the storm right. So it's kind of a frustrating thing. I spent 30 years working in the data world in insurance, and we are wrong almost all the time, and we are wrong because we underestimate the impact. So when a storm hits the west coast of Florida and does most of its damage on a mountaintop in Asheville, North Carolina, the models didn't say that was happening. They simply didn't say it was happening. And so the reason there's an arms race is because we are continuously trying to get the models to be more real time, to be higher fidelity. So if I build a flood model, I have to know what the soil is like at my house versus what the soil is like at your house versus what the soil is like at your house, because the way that flood is going to behave is going to depend on the consistency of the soil. It's going to depend on how many times it's rained in the past 2 months. So where in Arizona, for example, if the ground gets really dry, the ground won't absorb the water and the flood will be worse. So that means I need models that are taking in hour by hour readings about soil to soil conditions and all that sort of stuff to actually get to that level of accuracy. So, my comment here is that yes, the models get better all the time. Yes, they are wrong most of the time. So if you find yourself personally in a situation where you don't believe the risk that's been assigned to your property, challenge it, because it's one model out of many. And by the way, the other piece of it is the models don't all agree with each other. Okay, so I saw someone with a shirt from Verisk in the room, so back there, yep. So he's got a family of models that are very, very good. But there are another company, Moody's, has another family of models that is also very good. And there are lots of AI-driven startups nipping at their heels. And so we live in an uncertain world, and just because it's data and just because there's numbers and just because they're general linear models doesn't mean they're right.
These guys are the smart guys, but I'm the sales guy. So I have to answer this just a little bit differently. I just thought I'd show you this. You guys probably can't see this from way back there, but it says, furious homeowner says her insurance company flew a drone over her house and refused renewal for one minor reason. New York Post. So that's not predictive modeling, but that's kind of what you're talking about, that they're going out and they're just, people don't even know it. Richie can tell you, Yvonne can tell you, that they may fly over your house and say, you've got brush, you haven't cleaned your roof's in bad condition. And so you've got that factor in there on the individual basis, not on the predictive modeling basis. Predictive modeling is, it's something that has been discussed a lot around the water cooler in my business, especially with some of the guys that came before me. Earlier we talked about, you said something to the effect that 20% of the people live in catastrophic areas in California, but 100% of the people that live in California are going to kind of share the risk, because that's what insurance is sharing the risk. As far as the predictive modeling, when you say people are getting it wrong, predictive modeling is very, very, very important. But in the old days, an insurance company would write best in class. So my job, like right now, I'm the CEO of the company. We have a lot of things going on, but just to keep my head in the game a little bit, I handle 10 accounts, 10 like legacy accounts, and 2 of my customers in the next week are being non-renewed. They're huge fleets because predictive modeling. I think that the best time to write an account is after somebody's had their big catastrophe. Because if somebody's gone 5, 6, 7, 8, 9, 10, 11 years without something, it's bound to happen. And that if they have better behavior because of something that happened, that might be the best time to write it. And I keep going back to Warren Buffett. I mean, we represent some of his companies. I happened to be able to meet him a couple times years ago, but he always is on the right side of the risk. But predictive modeling, we had one insurance company called Cincinnati Insurance Company. Has anybody ever even heard of Cincinnati Insurance Company? They're a phenomenal company. They're best in class. Most people don't know about, like when I was young, I just heard of State Farm and Allstate. But they're a commercial, they do some personal insurance. And they didn't used to do predictive modeling. They would say, okay, Crest Insurance Group, what is your best in class? Love and Touche, what is your best customer? And so they would write segments of accounts or apartments. They would write maybe apartment owner or homes that may be in a bad wildfire area, but they didn't use predictive modeling. Now they are, Seth. Now they are. They all are using it. I don't know if anybody that goes by the old, gut underwriting, but I think for an entrepreneur in the room that's thinking about, I met a couple of young people that if you're really good at it, you could do well by still writing on people's behaviors.
Let me just add one.
Yeah.
Since we all are interested in AI and what AI is going to change, when we talk about underwriting, there are lots and lots of underwriting decisions that are never put in front of a human being. So I want to be really, really clear on that. So, we talk about, is AI going to take our jobs? Well, AI has already taken a lot of underwriting jobs, and this has been going on for 20 plus years.
On that happy note, you talked a lot about the increased costs of extreme weather and claims related to hurricanes and other disasters. But what is happening with the trend of insurance company profitability over the last 10 to 20 years?
Go ahead. Yeah. Well, it is part of the rate filings. So there is a provision in the statutes that a reasonable profit can be made. And you'll see ranges. We do object if we think it's in excess of component of the rate making, because every aspect of the rate filing, whether it be the permissible loss ratio, what they think they can lose for every dollar they bring in, what they can lose in terms of paid out in claims, there's our overhead expenses. So all of those components ultimately come to create what rate is being charged and what premium ultimately is being charged. And so that is part of it. A lot of states do look at those profit provisions, but again, insurance is over the long term, okay? So they have to rely on their reserves to be able to cover some of these significant losses that appear or occur to their book of business in 1 year, and then hopefully they have consecutive years where they don't have the losses to offset that. So it's trying to keep an even keel, because otherwise what you'd have is rates going up and down like a yo-yo. And so the whole principle is to try to keep consistent rates and premium being charged. It's currently going up. You can't disagree with that. There's a lot of factors, but I don't think it's based on what some would assume insurers are trying to be over profitable.
A lot of insurance companies, especially the last 5 or 6 years, they've had over 100% loss ratio. So they're actually losing some money from their writings of insurance. But some of the insurance companies are excellent at investing their money. They have huge amounts of money. So a lot of it depends on what the bond market's doing, what the stock market's doing, what the interest rates are. And so we didn't even delve into it. I mean, insurance is something we could talk about. I look in the room and I see all these like blank faces, like, oh, this is boring. If you came and spent like a day with me, I trust you, we could get you turned around. We could get you excited about it. Trust me. It's a fascinating business because it's a relationship business. Everybody has to have it. Every single person has to have it. Everybody doesn't have to have a new car. Everybody doesn't have to have a new home. Everybody doesn't have to have a new suit. But everybody has to have insurance. So, and people treat it like it's a commodity, but it's all relationship driven. But as far as the financial stability of the carriers, do you guys know, if you got a B plus, you guys are all the excellent students, but you might live with a B plus, right? Maybe, yes? But that's considered not really good in insurance. We will not represent a B plus insurance company. We can't. We buy insurance. We buy errors and omissions insurance. Our errors and omission carrier will not allow us to sell a B plus. That's correct, huh, Heather? And so we don't even like to sell A minus. So we have to sell A plus plus. And what Seth was talking about earlier, they're all reinsured by like Swiss Re, Munich Re, Berkshire Re, those types of companies. So anyways, the provision that the insurance companies are the bad guys, I'm not an insurance company, I'm a broker. But they're a necessary component of keeping our whole economy running.
Yeah, so when I first got into insurance, somebody said to me, it's a really, really good way to get rich slowly. And not that I'm rich, but I've seen lots of others get rich slowly. So it's a stable, it's a very mature business. It's a very mature business model. Insurance companies take money from you now, they pay claims later, they make money while they're holding that money before they pay the claims. So even if they pay more in claims than they take in, they make it all work. But what I'll also say is that insurance is not an exciting business from an investor perspective, right? So you don't get, the kind of meteoric returns. You don't get the kind of meteoric valuations because, there's kind of an iron law of how much money you can make. You can make somewhere between 10 to 15% of the premium you take in. You get higher than 15%, someone's going to come along and take those customers from you because you're probably rating them too high. You make obviously less than that, and your capital will begin to dissipate. So, it's funny because you look at like all the stuff we're telling you, like the sky is falling, but like on one hand the sky is falling, but on the other hand, like the numbers show, that the sky falls to 2 or 3% a year, one direction or another.
All right. And Cody will have a sign-up sheet if you want to spend a day with an insurance agent afterwards. You can talk to him, kind of like when my girls were little, I'd like bring your daughter to work day, something like that. Okay, we have time for one more question. And I like this question a lot because we talked a lot about this issue from the perspective of insurance companies and the perspective of the government. But this question asks, as a consumer, it seems like we are often at the mercy of government regulators and insurance companies. But what are some best practices and steps that we as consumers and businesses could take to address some of the issues that have been discussed today?
Well, I'll start and then I'll hand it to the folks who actually deal with consumers on a daily basis. So one of the piece that I'll say is short. So one of the things that I have seen, and I've actually seen data that shows it, and I feel like the word volatility was in the title of this presentation and no one's used it yet, so I'll use the volatility piece, sort of, kind of, is that because of the uncertain times we live in, the range of rates that you can get from an insurer continues to get wider. So, in an uncertain time, different people look at risk differently. And when they look at risk differently, they don't agree on what that risk should cost. And so I have only one piece of advice for any consumer, and that is shop, 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 shop. Because you will find, I recently in my own case, I reshopped my home premium, and there was a 300% difference between the most expensive quote and the cheapest quote. 300%, right? And they're all using the same data to evaluate the risk. So I'll let people who know more about consumers say more, but that was my little piece.
No, I'd agree. I think shopping is the best thing you can do. There are a number of insurers writing in Arizona, and avail yourself to an agent, or get in the phone book, get on the internet, however you want to do it, and try to get quotes based on your specific risk profile. I mean, you'll find out exactly what insurers want to know about you. Whether it's your auto, they can look you up. Your home, they're going to want specific information. So shopping around. The department does do annual surveys for auto, and so we have 14 categories that identify different types of drivers. And we get quotes from all the insurers writing in Arizona. And to his point, the range is dramatic. You can see policies for one characteristic type of driver that we have as a hypothesis or hypothetical, and it'll be from $400 to $2,000. So it again depends on the appetite of the insurer, because the insurer has the discretion of who they want to write and what their rating criteria is, and they're going to rate those risks that they are most favorable to with the best rates. It's not to say you won't be able to find something specifically, but it's really finding that insurer that's going to write to that. So shopping around. The other thing is insurance is a safety net. It's not a warranty, I think, as somebody indicated. It's meant to be there in the event that you have a significant loss that you could not personally afford. And I understand that, sometimes you can't afford anything, but having a higher deductible will decrease your rates, but it also imposes that you're going to pay more, and that will incentivize you, not to file a claim. But again, it's a safety net. So frequent claim filing is basically what a lot of insurers look at. I mean, it's the number one thing that we've seen is you've had too many claims. And more recently, it's the windshield claims. Arizona is specific, where you have people shopping around at the gas station or the car wash and wanting you to file a windshield claim and saying that your insurance has to pay for it, there's zero deductible. That's true. The state law requires that they offer you a zero deductible, but once you start utilizing that, guaranteed they're noticing it.
That's good points. I got really excited, and I'm like, I got to find this LinkedIn post I put up there, and I'm like, I found it. So I put on here a couple years ago. You guys use LinkedIn. I'm a big, huge believer in it. Insurance is like tequila. You can choose the cheapest one, but don't complain about the headache. So no two insurance companies are the same. The coverage is what they pay. You can go online, you can review them. That post, by the way, and I'm not like, 54,000 impressions. That was kind of cool, because if I put something on there like buy cyber insurance, I might have 5 impressions. So that one, whatever, that was a home run for me. But don't treat it like a warranty. Remember I talked earlier about the most expensive layer of insurance is first dollar coverage? Take some of the risk. Underwriters love people that put skin in the game. Put skin in the game. Myself, I'm in a position now where when I first got started in life, I had a $500 deductible. We carry $10,000 deductible on our house and our cars. Any little nuisance claim, I'm going to try to take care of it, because you don't want to have, like he was saying, they have to pay the glass claim, but the insurance company can non-renew you. Another little plug for us, because we've worked really hard. Insurance companies, we're an independent broker, so we represent a wide variety. I mean, we could get quotes that ourselves are 300% within our own shop, and there's other really good brokers too that can find and help you with that. But what insurance companies do, just on the business side of insurance, they'll come to like the broker that you were talking about earlier, maybe a person in Payson or something like that, who has one employee themselves, and I applaud these people that are doing it like that. But they may only have one appointment, because the insurance company will say you have to have $1 million of premium with us to have an appointment. So we have worked really, 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 really hard, being based here in Tucson. We're competing with the guys out of New York City, out of Chicago, on accounts all over the country. But based here in Tucson, we have sufficient markets to go shop for our folks. So it's been a privilege for me to talk. I know you want to wrap. I don't know if there's any more questions, so I guess this is my last time on the mic. Thank you very much.
Yeah, actually, round of applause for our panelists. Thank you all, and thank you all for your really great questions. I'm sorry, there's a giant stack and I couldn't get to all of them, but thank you all for your questions. So I'm going to turn it back over to Paul for some closing remarks. Here you go.
All right. Thank you, Michael. How about Michael's efforts as our moderator? Yeah? Professor Fricke, thank you. To our panel, you definitely delivered. Big round of applause to our panel. To our sponsors, Doug and Claudia Zanes, Vantage West Credit Union, and the Humberto Lopez Foundation, thank you for allowing us to do this. Big thank you to the team, all the students, and of course, all of our guests. I'm just going to offer kind of a closing thought, and then we're going to kind of wrap things up. I'm sure we all remember the name Peter Drucker. And Peter Drucker is somebody that, I have studied and have used in both my undergraduate and graduate courses, and he had one of my favorite quotes, speaking to turbulence. He said, during times of turbulence, that's not the danger. The danger is using yesterday's logic. And I think this really hit a chord with me when Dr. Racklin talked a little bit about the predictive models and kind of the backward-looking orientation of the industry. I think in the end, and I think my panel would agree, we're all accountable, number one. We're going to get further ahead if we all understand that accountability is going to rest with all of us. You're going to need to do your due diligence as consumers. We're going to need to pray that we continue to have competition in the markets. If it ends up being that it is a government underwritten policy, that in and of itself is a market failure. So let's pray that we have choices and options in the marketplace, because I think we're all going to be better in the end. I thought that today's symposium really kind of met good timing. All of us are dealing with this in some shape or form, and I really want to commend not only the panel, but Professor Fricke for also kind of emphasizing the ethical aspects of today's discussion. So we have a couple of parting gifts for our panel. So Michael is going to be a two-man duty here. We have, you want to get the MBAs? Yeah, okay. So we have, there we go. We've got some gifts from not only our Eller MBA program, which of course had to one-up us with the red, but that's okay. So there are some gifts from our Eller MBA program. And then of course we have a special gift from the Center for Leadership Ethics for each of you as well. One last round of applause to our panel, please. Okay. Not going to let you off the hook quite yet, right, Professor Fricke? So if you enjoyed today's program, and if you'd like to get a little bit more involved with our Center for Leadership Ethics, I'm going to make a pitch right now. In October, we're going to be running our 23rd annual Collegiate Ethics Case Competition. It is the biggest ethics case competition on planet Earth. Would you agree? We actually recruited Professor Fricke away from the University of Illinois' Geese School of Business because he was bringing teams to compete. Every year, I write a new case. And what that means is it kind of levels the playing field. And the students come into Tucson from Canada, the US, and Mexico. And these are the very best students from both public and private institutions. And they demonstrate their ability to analyze this case using an ethical framework. We always need judges. And if nothing else, as I've said to a few of you, if you want to come tap, poke your finger or your toe into the fountain of youth, you'll be 5 years younger after coming to this event. It is invigorating. And oh, by the way, for those of you that have employment needs, this is a really, really, really good recruiting opportunity. You get a chance to strike up conversations, get to know the students, not just from all over, but also our own students from Eller and from the university. So as you can see here, we've got a QR code that we want to encourage you to go ahead and click onto and let us know if you'd be interested. Otherwise, we want to thank all of you again. This is the end of the program, but you can certainly stay for a while. Continue the networking. Our panelists will be here for a little bit longer. Have a wonderful Friday. Thank you, everyone. check out of your room?
I did. I did not. Well, I don't know if I checked that. I just removed my stuff.
Well done. Thank you for the invite, Cody. Good job. You okay? I know.